The Fed has officially announced a recession, and now US consumer confidence is at a 9-month low. In this video, we'll cover the Fed's announcement, the implications of a recession, and what you can do to get ready now. We recently covered the global banking collapse spearheaded by Silicon Valley Bank. Though Vice Chair of the Federal Reserve, Michael Barr, said the banking sector is sound and resilient, economists say that the economy is headed for a stark downturn. In a Federal Open Markets Committee meeting, staff members summarized that given their assessment of the potential economic effects of the recent banking sector developments, the staff's projection at the time of the March meeting included a recession starting later this year, with a recovery over the subsequent 2 years. US economic data also suggests that a recession is on the horizon. The Conference Board's leading economic index for the US fell by 1.2% in March, falling to its lowest level since November 2020. This indicates that economic weakness could soon intensify and spread throughout the US economy. What's more, the Treasury yield curve first inverted in March 2022. The typical timeline for a recession after the inversion of this curve is roughly 1 year or so, putting us right in the sweet spot for recession talk. These data points have been described as compelling and brutally bad leading economic indicators. As we discussed in our video on how to survive a recession, economists and politicians have argued about the likelihood of a recession for over a year. At this point, it's no longer a debate about whether or not we will have a recession. Rather, it's just a matter of when. Since the Fed is now saying that the effects of the banking turmoil will likely lead to a recession at the end of 2023, with a recovery happening in 2024 or 25, we should consider the short and long-term implications of this crisis. Fed officials believe that economic conditions will lead to tighter credit conditions, and that these conditions will also weigh on growth, jobs, and inflation. One official listed the current state of inflation as unacceptably high. Truly, many sectors are already feeling the impacts of inflation and the slowing economy. Venture capitalist, SPAC sponsor, and social capital CEO Chamath Palihapitiya says higher rates have created a wave of destruction across whole sectors. In a letter, Palihapitiya pointed to higher interest rates causing unprecedented headwinds for businesses. Tighter financial conditions are also causing chaos that contributed to what he called one of the toughest years he's faced as a business executive. Some speculate that the market is headed into a new regime defined by higher interest rates and persistent inflation. In this environment, many investing approaches that worked over the prior decade won't yield much success. Since leading indicators, consumer confidence, and CEO confidence are all pointing towards a recession, we've seen slowing in buying activity. Consumers are spending less on goods and services, and businesses are pulling back on spending as well. Top companies in seemingly every major industry have announced layoffs over the past quarter. Amazon, Microsoft, Google, IBM, and Zoom announced massive layoffs, as did Meta, Spotify, FedEx, and Lyft. Combined, there have been over 40,000 job cuts at just these few employers. In terms of consumer sentiment, travelers are cutting back on vacation spending, diners aren't eating out as often, and hotel brands are bracing for impact. Food prices are also rising at the highest rate in decades. The price of eggs has been so widely discussed that the term eggflation has now become a catch-all term for rising food prices. Rice is another basic food staple causing disruption, as rice production is set to have its worst year in 2 decades. Even in places that traditionally rely on wheat, demand for rice as a more affordable grain is on the rise amid the war in Ukraine. At one point, Ukraine made up 9% of the world's wheat export, but much of their production is down as a result of the Russian invasion. According to the US Department of Agriculture, the price of food for home consumption rose by 11% last year, the highest yearly percent change since 1974, and it's expected to rise by another 8.6% in 2023. As food inflation in the US is sky high, Americans are struggling to buy their everyday groceries. Many Americans are turning to buy now, pay later apps like Klarna, Affirm, and Afterpay, which allow them to make purchases in installments. As of March 2023, 21% of buy now, pay later users have used these apps to purchase groceries. There is no sugarcoating that this is the effect of the current economic environment. If you haven't already, make sure to watch our video on how to survive a recession, where we go in depth on tactics that will make anyone recession-proof. What's important to know now is that the necessity for an emergency fund couldn't be higher. It's also time to consider stock market strategies to utilize during the recession, including options trading and dollar cost averaging. Purchasing put options will allow you to earn money as the stock market falls, and dollar cost average will allow you to gradually buy long-term investments while their prices move further off of their peaks. Consider the Fed's announcement as a warning. We now know what's coming, and we also have the tools to prepare. Let us know in the comments how you plan on preparing for this period of recession. And as always, subscribe for more content like this. Thanks for watching, and we'll see you next time.